And actually, it's not about price. It doesn't matter what the price is. Right now, I can trade at any price. And so where most retail traders are focused on price. I actually don't care about the price. I just care about what's happening around me. So we're almost complete opposites. If we think about it, by the time it's gone there, that trade is gone. The good
Mhm.
part, the edge part of it. And this is the thing as trading, the edge is getting into it early. That really is if you can see it before others, and you can do that before others. So if I wait for the price to move, I'm going to be late. I'm always going to be late. There's things that charts don't tell us. And the overriding thing between all of these sections, whether it's position trading, the hedge fund, which I'll talk about at the end, and the Norden method, the overriding theme that I would like to get across is that the edge is found in the doing things that other people don't see. Bar might tell me what the high and low is, but that high and low could be created in millions of different ways.
Mhm.
And that's what's important.
We have two different episodes on our channel where Gary has come on. We've learned a lot about his past and his journey into trading. It's fascinating. I've enjoyed both of our conversations tremendously and very excited to hear what you're going to be bringing for us today around this topic of trading without charts and specifically reading between the lines. So without further ado, I'll let you jump into it. If there's anything else for introduction you'd like to say, and then take it away, please.
No, thanks, and thanks for having me on again. I've enjoyed the last two interviews, so thanks for that. And I think because I come at the business from a very different angle, I thought I would elaborate on this idea of trading without charts. What is it we're looking at? Why do I do it? Why do I trade that way? What are the benefits? And I'll come at it from not just a scalper. So I'll talk about it from an order method scalper's perspective, but I'll also talk about it from a position trader's perspective. But that's how I sort of originally learned to trade like this. And also from my perspective of running trades for the hedge fund and N squared. So, and it's the same sort of story. And so I explain why each of those needs to trade in this way, and what it is we're looking for. So it won't just be for scalpers. For those of you that might think, "Oh, I'm not a scalper. This won't happen for me." Hopefully, there'll be something that will be interesting to you. So, if we start rolling back to the very start, how and why did I trade this way? Which it really does go back to my very first start in this business. So that's trading the crash of the Nikkei, 1990 to 1992 kind of thing. I was a market maker of Japanese warrants. And essentially, most of the time, my job was making prices in warrants. So learning to be a market maker, that's one skill in itself. Um, but but during that process, we hold positions as market makers. So how did I decide what to trade and why? What did I hold? We had very tough, very strict position limits. So it wasn't like I could just hold whatever I wanted. So what was it, and how do we trade? How do we hold positions? Why did we do that? And that's where it sort of started. So this is obviously pre really much of computerized trading. Trading was on the phones, orders written on tickets, and we had minimal screens in front of us, literally just almost like a Reuters screen. Bloomberg's weren't really around in 1990. Things like so, very minimal technology in front of us. We could print charts if we wanted to of Japanese stocks on these quick 10 machines, but generally that wasn't that they took some time to do it, so it wasn't something that we were printing off all the time. So how do we pick trades? How did I learn how to position trade around my book? And the reason was actually quite more simplistic to I think how a lot of traders go on today, and it is simply that the way that the book was structured, the market, there are about 450 warrants, and we all traded about 110 made markets. Now, for some reason, the market was split in terms of alphabet. Somebody did A to H and blah blah blah. I started off trading S to Z, and what that meant was that, for example, somebody trading the A's might have a bunch of steel companies, and I might have some steel companies, and so forth. And there might be some chemical companies on one and chemical companies on the other, some housing companies, and essentially, the way we would trade was very simply like if you saw that steel companies warrants and stocks were rising, you would go out and be buying still company stock warrants on my book if that was happening intraday, if I saw some strength. Now that is very simple. Now the next thing is what price, and I think this is where I think modern day traders, I think, have a problem that we didn't have. So if I see that someone else is being lifted, that means people are buying still warrants off of them. I'm going to immediately try and buy them on my book. Now, what price? And well, the reality is here now. And I think this is where, as I said, I think traders today get in a bind because they'll say things like, okay, I like this and I'll buy it if it on a retracement. If it pulls back to here, I'll buy it. Or conversely, they might say, if it breaks through this level, I'll buy it then. And to me, that really confuses the trade
Mm.
because if the information in front of me right now, back then, and even today, if the information says this is going up, buy it, people are buying this stock or buying this sector or whatever that is, I'll buy it now on this price because that's what's happening. If I think about it, if I'm waiting for it to pull back to a level because I'm using that on my chart and I think that's I should wait until it pulls back, then well, if I think this is going up, why would it pull back? So, and if it pulls back, I'm probably wrong. And conversely, why should I wait for it to go up and break through a level? Because then I've possibly missed a move. So our trading was quite simplistic. If you see something's going up, you go and buy it. Now, as market makers, of course, we can set the bid price a bit higher and try and buy that way. Of course, that makes it a little bit easier. Um, but otherwise, I would, and my prices would reflect that. But the decision making was quite straightforward, really. If you saw things, so for example, a big story today as we record this on the 24th or whatever of July, the yen is strengthening considerably. Okay, so back then the yen was also a big story. So if you saw the yen strengthening during the day as you're trading, obviously export companies are going to get hurt. You know that export companies their stocks are going to fall, therefore the warrants will fall. So you would just use that information to try and short, and that could be a Sony or whatever, that kind of thing. And we would expect Japanese export stocks to weaken. So we would use what people call fundamental information. Yep, if that's happening, that does drive the markets. There's no doubt about it that a strengthening yen will hurt Japanese export stocks, and a weakening yen, as it has done over the last couple of months, has helped the Nikkei rally even today, and with 20, 30 years later than when I was trading. So we do use fundamental information. We build the picture, and then we just trade now. And I think that makes it a lot easier to make that decision of when do I pull the trigger, which is what a
Mm.
lot of people are trying to really finesse that. Oh, if I just wait for it to pull here, I'll get a better level. Well, it might not get there if you're right, and this thing's happening. If I sit there and wait for this stock, let's say yen is strengthening, I think that Japanese exporters are gonna weaken and go down. I can't wait for them to rally to do that because they're not going to do it. So, and similarly, if I wait for them to break through a level before I short, I could have missed the trade. So basically, when do you trade now? What price? This one, because this is the one where it hasn't quite factored it in yet. So that's really how I learned to position trade. Use that flow of information, and it is fundamental information. And actually, it's not about price. It doesn't matter what the price is. Right now, I can trade at any price, and that's it. Will get to the Norden method as well. One of the key things is, can you trade at any price? If I have to wait for certain prices to be hit, I'm going to be sitting around a lot more. I'm going to miss actually a lot more trades. And I'm actually, I think, making rules for myself that I don't need. So quite a
Mm.
simplistic style of position trading. And we'll do a little trade review at the end of this, which is something that happened today, which is very much along those lines. So that hasn't changed for me. So that's the sort of position trading aspect of it. How do I position trade? Build the picture of what's happening, and then when something is moving that I think is going to affect the contract I'm trading, jump in now, and no second guessing, no trying finessing, just do it now. So I actually think that makes things a lot more straightforward. And
Can I
again, the
ask you a
other,
couple?
but
Can I ask you a couple clarifying questions before you move on? Because you said a lot of really
yeah,
interesting things there, as well as I think a lot of things that would fly in the face of virtually everything that's talked about online, and everybody listening, including myself, the way that we would think about it and the way we would excuse me, interact with the market. So just as some clarifying questions, when you say that you had the book and you had S through Z, what exactly does that mean, and what exactly was the book that you were talking about?
So as a market maker back then of warrants, there were about 450 different warrants that our company, our desk had to make markets in. So we split that between four traders. We each traded 100, 110, 120 each, something like that. And um, the way the book was split was just in alphabetical order. Um,
Hmm.
so, for example, if you were trading, this is Japanese warrants. So if you were trading A's, you were trading like companies that are still here today. Asahi Brewery, for example, would be an A. Canon warrants, Canon, the camera photocopier company, they had warrants. They would be a C. You'd be trading Canon. Bandai, the toy manufacturer. These are all sorts of names in the top. I started off trading the last book, S's to the end. So Sony didn't have a warrant. I'm trying to think of any famous companies in mind. Um, Toshiba Corp. So that's how it was split. But if we wind forward like 15, 20 years even from that, and even to I say the example I'll show is even today, it doesn't matter. But if we wind forward to when I was trading convertible bonds as a market maker for ING, book was split differently then, but same thing. You're asking around what's happening, and if you're seeing a certain sector fly or something happening, you'll adjust your prices as a market maker, and you may well take the position there as a position trader.
Very good. So when you're talking about you have access to you're managing these books, the way that that's actually interacting with, is this a screen that you're having individual depth of markets on, and that's what your individual books are, or is it something else?
No, so back then it was, we're talking very rudimentary. We were trading with writing tickets, writing trades down. There was nothing technological about that at all. I just, knew my book in my head almost, although it was kept somewhere. But I knew the book in the head. But go forward, yes, the trading is done. Can be done automatically, can be done electronically. Positions kept electronically. Where the trades are isn't the issue, isn't the big point. The point is um, that it's a more simplistic way of trading. If you're going to trade a proprietary, so non-systematic way, if you want to trade, we'll get to the systematic trading a little bit later when I talk about the hedge fund. But if you want to trade in a non-systematic way, you want to trade and react to what's happening, which is what most retail traders want to do. They don't have the scope to create systematic trades as such. So if you
Mhm.
want to trade to react to what's happening, then build that picture, which I do fundamentally. What does drive things? What does drive this market? And I do think that the fundamentals will drive that market. Like strong yen will react. Japanese stocks will react to that, and so forth. Which we'll say we'll get to the trade at the end. But about the finessing of the price, I think is where people make the mistake. I think often, they're too focused on price, and I'm never really a price trader. Okay, I always say like Norden method is value. And what does that mean? Well, value's changing, and that's the difference between being a price trader and a value trader. As a price trader, you're waiting for it to hit prices. As a value trader, so the way I explain value to people is this. Um, this is the way I explain, because in the Norden method, I have to teach people how to think like this, how to think like a value trader. So this is
Sure.
the example I use. Let's say we have two cars, and they're both pretty much the same in terms of spec. Toyota have one and Ford have one. They're four-door family vehicles. They have pretty much the same spec on them as well. Okay, um, and they both retail for $25,000. Okay, that's the price. So we know the price. We can get data on how many of these cars they sell as well, right? How many cars Toyota sell, how many cars Ford sell, etc. Okay. Now, let's say that the price of the Ford decide they're having a sale this week. They cut the price of their car from $25,000 to $20,000. Okay. So now, if I ask you, the Toyota, is it still good value?
No.
Has the price changed
No.
of the Toyota? No. And this is the difference between price traders and value traders. So the Toyota price hasn't changed. The price is the same. A price trader doesn't see something. A value trader knows it's more expensive. because he's looking at the Ford, right?
Mm.
What do we think Toyota's going to do now? How
Potentially
many
lower the price.
how many are they going to sell? They're probably going to have to cut prices, aren't they? They're probably going. That's how markets work. So this is how I learned to be a market maker, to judge value, and this is how I say when I talk about value, we are value traders as Norden method traders, and I'm generally a value trader, not price, because the price of the Toyota hasn't changed, but the value has. How do you judge value? You actually judge value by looking at different markets, and that's
Mm.
something that you won't see, for example, in a chart. In a chart, you only see the price. You'll see the value change afterwards when the Toyota, in this case, falls towards 20 because they have to.
Yeah.
So by looking at everything around it, and we do this every day when you buy a computer, when you buy a television or whatever, right? You are judges of value. Everybody is. No one just goes out and pays on price. But when people trade, they get focused on the price. The
Yeah.
price has to move here. And what I'm saying is the price doesn't have to move for the value to have changed.
Yeah.
So in this sense, what I would see is, okay, the price of this warrant hasn't moved yet, but the value has. This is looking cheap to me now. Why? Because everything else in that sector has moved up. So I'm going to be buyer of this now. So that's the aspect of what I'm saying. And so the price, I don't have to wait for the price to move because at that point, I'm not buying it under value anymore. So I hope that sort of explains like why I think you shouldn't look at price as much, and the value of this thing has changed even though the price hasn't, and that's the concept. So what price do I go and trade at? The current one. I just go, if everything's changing around me, I just go and buy it now or short it, whatever it might be.
Yeah, it's a very interesting topic, and I'm fully on board with this idea that there are too many peripheral things that just complicate the trading process that should not even be focused on. And for everybody listening as well, as we're going through this, if you have a question that sparks that you'd like to ask, please feel free to put that in because we can interact with on that level as well. And a couple more clarifying questions just before you move forward, because I don't want to get too far off track here. But I am interested to know, even something maybe as simple as, okay, if we have a strengthening yen, that this is going to affect export companies. That type of looking at that landscape, seeing some of these fundamental factors, and being able to connect those dots. Is this something that was just intuitive and something that is common sense to you, or was this something that you're trained in to understand? I think being able to look across and understand what is impacting what is fairly difficult, and I'm sure most of us as retail traders are not very good at this. What are your thoughts on that originally? Something that was part of being trained in that environment, or was this something that just intuitively seems obvious?
Yeah, no, I mean, no, no, I think anything that's intuitive as trading. I mean, you kind of learn the hard way, but and in that sense, yeah, it was something that was trained into me. For example, at the end of the day, if I had, particularly, I was 19 when I started trading, and everybody on my desk wanted me to fail because I was too young, right? So everybody was really happy, like if I had a bad day. And so, for example, if I got to the end of the day and I said, "Oh yeah, I am short steel companies," and everybody said, but we said we were getting lifted in steel companies, they were going up, they were going, why did you end up short? And I'd look a fool, right? And so I had to be aware, and I had to be aware of what was happening there. If there had been news out, or if there had been, if the yen had strengthened considerably and I ended up getting hit out of sight in every single export stock going, I would have been crucified, frankly. I mean, I would have been, absolutely mauled by my senior traders. And back then, we had to report to head traders and head of desk and blah, blah, blah. So if I had those sorts of losses, and it usually worked like that, that's the reality. That's how the market worked. Um, and that's what I've seen in all places. So I think, yeah, traders today are taught, oh, the fundamentals are too difficult, and that it's not. I mean, it's not too complex, and most of the time, there either isn't a trade, or if there is something, it's reasonably clear. But I do think that you know at every level that I trade, I have to be aware of what's happening there. And so where most retail traders are focused on price, I actually don't care about the price. I just care about what's happening around me. So we're almost complete opposites. They don't care
Yeah.
about what's happening in terms of the yen or whether they care about does it trade through that price. I don't
Yeah.
care about what price it trades at. I just care
Yeah.
about what's happening. And if right now something's happening and I think this is going to go up, I'll just buy it. What price? This price. Because I
Yeah.
think now it's undervalued because everything else has moved.
And so one of the biggest issues that all traders face is just trying to enter the market, getting the timing right. And I'm assuming this is what you're talking about of why you're getting this wrong is just focusing on price over maybe a concept like value. Are you saying that if you have all things even and you have that the picture right, you've identified strength, which I'll ask you about in a second, timing doesn't become an issue anymore. It's a matter of just acting now, because even as you're describing it, it sounds like there would be a big issue with having the right idea that, of course, these things are happening. So this product is going up, but potentially before it does, having some kind of a counter rotation or something else. But if you're seeing everything correctly, that doesn't even factor into the equation, or
No, not really. It's yeah, this is happening. I'll buy it. Now, the other part of that is you're backing yourself to read it correctly. And
yeah,
that's I think why people choose to trade price because then they say,
sure.
you know what, I'll leave that decision to everybody else.
Mm,
And then when they've decided where it's going, I'll get in. And from my perspective, if you constantly do that, you're going to be late. You're going to be late. So the decision that I took, and I put a video out many years ago on my YouTube about the day I became a trader, which was actually not my first day of trading, but it was the day that I learned what it took to be a trader, which was the
mm,
day that I made a massive decision on one particular warrant. Um, and the decision I took was I've got to try and do this myself because I was getting smashed on it. Not just me, everybody, every market maker was getting smashed on this one. It was a absolute pig to trade. And one day I just said, if I keep doing this, this is going to cost me my job. I only had a few months probation to make it as a trader. This one particular warrant out of the 100 could have finished my career. It finished my predecessor's career essentially, because it
mm,
was such a horrible thing to trade as a market maker. So one day I said, I have got to figure out what happened to this thing. And if I can't, I'm never going to make it as a trader. I'll be like the last guy that had this trading book. The reason why I got this book at 19 was because the other guy got smashed. So I
mm,
realized pretty quickly, I've got to make a decision. I can't just let the market make decisions, which is what I was doing. I was, as a market maker, making the market prices and getting absolutely screwed over with the market when one of the big American banks would move this thing, just move it. So I had said to myself, I've got to figure this out. Now, this is much more complicated, this particular warrant, than what I've just said about the yen and export stocks, for example. That's a damn sight easier than what I had to figure out with this thing. But one day I said, I've got to put my line in the sand because this thing's killing me, like this particular one warrant. So the decision I made was I am going to stick my neck out. And if I can't do this, if I can't understand it and I've got this wrong and I constantly get it wrong, this business isn't for me.
mm,
And I was prepared to make that decision. And I think that's what, by saying, if I just follow the price and just say, well, everybody did that and the market did that, I'm not, I don't call that trading. You're just following others. And, I don't consider that as trading. I think you've got to be more independent. So um, that was when I figured out, yeah, and I got it right, by the way, which was if I didn't, that day I would have been sacked, I'm sure of it. But I read it right, I got it right, and I made a lot of money on it. And I figured, yes, I can do this, and it gave me the
mm,
confidence to do that. And then ever since then, it's just always said, if I can't figure something out, which happens a lot, I'll leave it alone because, of course, we don't have to trade. If something's moving, and again, when we go to the example at the end, I'll talk about, like, for a lot of the time today, there was just I didn't understand the move, didn't like it. Then now I see a trade, now I'll do it.
mm,
Um, so, but it's about, yeah, I think if it's people think it's too hard, then they say, I'll let the market do it. But if we think about it, by the time it's gone there, that trade is gone. The good
mm,
part, the edge part of it. And remember, and this is the thing as trading, the edge is getting into it early. That really is, if you can see it before others, and you can do that before others. So if I wait for the price to move, I'm going to be late. I'm always going to be late.
yeah,
So that was the way we were trained to be like fundamental traders. If you think back to the pits, or go back, go to when I was in the pits trading, all we had was a trading card, pencil, and screens above. And think about how are they trading. So Bund traders in the afternoon in London pit, how are they trading with just a piece of paper and a pen against the likes of JP Morgan, Goldman's? How do they trade? How do they make money just with a piece of paper and a pen? Well, what are they looking at 2 in the afternoon? They're looking at US bonds, and they see US bonds ticking higher, bond futures. They're seeing the 10 years and the 30s ticking higher, and they're going, we're going to move higher with it. They don't have charts in the pit. They can't see that. And then the other things that I'll get to in a minute when we talk about the Norden method and scalping, there's some other things that will go into short-term trading. But essentially, what's happening? Bonds are going up. I'm a buyer. That's it. What price? I'm just the best bid, right? If you're a market maker, you just want to be the best bid. So I'm 15 bid, 16 bid, whatever it will be. So that's the simplicity
Mm.
of it. And if you can, and it is, you don't have to be a macro expert to build that picture. But I think it makes trading much more simple. Yeah, I can see this. I can see it's going to drive my product higher. Where do I buy it now? Yeah. So from a position trading perspective, that's how I learned to trade position. Use that and then just trade. So I think now if I move towards Northern method scalping type of situation, okay, between the lines, between the chart, what do we do? So there's things that charts don't tell us. And the overriding thing between all of these sections, whether it's position trading, the hedge fund, which I'll talk about at the end, and the Norden method, the overriding theme that I would like to get across is that the edge is found in the doing things that other people don't see. And particularly when you move into the hedge fund space, you've got to create trades that are not visible clearly, which I'll get to in a minute. But let's think about scalping. Charts to me don't help scalpers, right, at all. The things that the order method and scalpers like me will look at are liquidity, pace of market, how were the trades filled. So not just looking at the price, but how was that price created, how was it filled. I say pace of market, you don't see that in a chart. The speed, the pace, the liquidity not shown in a chart, the way the market traded. So I might see that, in a bar, I might tell me what the high and low is, but that high and low could be created in millions of different ways.
Mm.
And that's what's important, how it was created, the pace. So for the Norden method, the pace of market, the liquidity, these are all important things. They will, our decision making, how to trade will depend on these things, not the price. We can trade at any price at any time if these other things are in line with what we would want in our style. So pace of market, liquidity, and how the market, how orders are being filled. Those are the things. And again, because they are not in the chart, you can't see them in a candlestick chart or a bar chart or whatever. Because of that, to me, that makes this a stronger method, right? And like if you can do things that people can't see, it's hard to replicate, and that's
Mm.
important because that's how you keep your edge. And that's obviously essential as traders. So the fact that other people can't see it is really important. That also goes to the fact that same with the position trading. If I just say I like this, I'm buying it now, whether it's Northern Method, hedge fund, or position trading, it's hard for people to see what I'm doing. They can't predict what I'm going to do because I'm not based on on a level or anything like that. It's just right now this is happening. I buy it. No one will know what I'm doing. Which particularly when you trade big, if you're an investment bank or hedge fund and you want to scale, it becomes even more important that people can't see you. But you hear a lot from retail traders about I got stopped out or they stopped me out, and I'm a big not a believer in the they. There really isn't people out there targeting retail traders as in that way generally. But if you place your orders around well-known levels, and let's say spot gold's been trading around 2400, and therefore futures similarly recently around 2400 plus. If and we know that people are not going to put their orders exactly there, but if you place your orders $3 or $4 or $5 around that, you're going to be very visible and you're going to be chopped around. There's no doubt about it. But no one can see where I'm trading because I don't know myself until I just decide, make that decision. And I can trade at any price. I think that's important. And something else I learned over the years. Try to hide what you do.
Mm.
Just, make sure that people can't see you clearly what you're doing. So it does that. It hides me from what people are saying, hides me from what people can see on their charts, and it also provides me with a style of trading that I don't think other people are going to find, and that's important too, to keep that edge. So that's from a scalping Norden method. Those are the things. So again, I'm not price driven. I'm not volume driven. Even it doesn't matter to me what the volume was at that price. For me, what drives what I want: liquidity, how they're being filled, pace of market. Those three things. There's certain things I'm looking for within those situations, and then around that, with the certain things that I'm looking at, I suspect or I expect most of the time these are situations that retail traders will generally make mistakes with, and the Northern method is designed to pick those mistakes off using these things. But as I say, not seen in a chart, not being able to seen by other people. So I think that's the strength.
By far, one of the biggest issues that we all have as retail traders is people that are getting on and people that are have successful trading careers. They're not just lucky. They're not just born under the right star. They are actually doing things different, thinking different. And hearing this perspective is wildly fascinating. When you're talking about hiding what you are doing, is this specifically so that you don't have any kind of a resting order in that can just get absorbed? Or is it more of hiding what you're doing in the fact that you're just moving in the market in a way that is not in alignment with everybody else is doing? So it's not so much that people are actually seeing you and taking your orders, but you're just moving differently. Could you clarify?
Yeah, it's a bit of both. So no, I don't generally leave or resting orders in the market. No. And in terms of a scalping perspective, liquidity, and that's always changing. So I might put an order in and then see something I don't like and pull it, straight away. But Northern method trades are generally filled within 1 or 2 seconds anyway, and exited within a couple of seconds as well. So it's partly that I don't want to leave orders in as well. I think that's is something that it will make you obviously visible to people that your orders just left in there. And there are reasons for that as well. And that again, a lot of professional traders won't want to leave orders in markets for too long. Um, but secondly as well, it's about that kind of um, I'm not saying randomness, but I don't want my trading ever, even though I'm only trading, small lots for myself. It doesn't matter. I don't want people to be able to easily see what I can do. And that transitions into a bank environment. A hedge fund, it becomes a bit different, because if you scale to a reasonable size, everybody will see what you're doing. That's the hardest part of that, is to try and hide what you're doing that way. I think when you're trading for yourself, the hiding, and I've just seen a question there, the hiding orders is not about, it's really about saying, I'm taking that excuse away. And this is something that I think is really important to come back to being an independent thinker as a trader. um, Take excuses away from people. So a lot of traders, you hear that, oh yeah, they triggered my stops, or they forced me out, whatever. Well, if I'm trading this way and I know that I'm completely random, like I don't know 5 seconds before that I'm about to trade. That's the reality with the Norton method, right? 5 seconds before I'm trading, I probably don't even know I'm about to trade. Then something happens with liquidity or pace of market or whatever it might be, triggers a trade opportunity in out in 2 seconds, right? Because I don't know, I can take that away, that excuse of, oh, somebody tried to hurt me. I know that's not happening,
Mm.
right? I know that's not happening because I didn't know myself 4 seconds ago I was going to trade. So again, trying to take that away and then making that it's my decision. It was all my decision. So again, I think I'm a big believer in all facets of taking excuses away from people and just say, don't, if you're as a coach of a soccer team, you'll have people say things like, "Oh, it's a really wet day, or the weather's terrible." If I hear that from any players, right, that's on the bench. They're on the bench straight away. No, no excuses. No excuses. As soon as you start hearing that from someone, that's a really bad attitude.
Mm.
Weather's the same for everybody. We just cope with it. You just play accordingly, right? You just have to adapt to it. So it's really about saying, there's no excuses behind this. No one's seeing what I'm doing. Um, and then, as I said, but in a bank environment, it does become more important that people can't see what you're doing. So that element of randomness, and anybody out there that sort of plays poker will understand this too, right? It can't be obvious what you're doing on a poker table. There has to be that element as well of, you play a weaker hand as strong as you might play a strong hand sometimes, because you've got to mix it up on the table if everybody can see that. Now a poker environment's different. There's only 9 players 10 players around a table, much easier to try to work out what everyone's doing. Trading is more difficult. But if you are trading at a bank, which I have, then yes, you can be visible. So finding trade methods that basically your entry is almost random. Until you see that information, you didn't know you were going to trade, and then you see the information, you just trade right there and then.
Yeah, very interesting. And one thing I'm taking away from this as well is I think in trading, it's very easy to be making all of these decisions that are somehow like on the fringes of even what you understand you're doing. And I think it's easy to lose sight of the fact of what is the actual job here? What are we trying to do? And just thinking through things very tactically and practically, and not making so many decisions because of something that you don't really understand is telling you to do it. Is something I'm taking away as you're speaking. But please continue.
Yeah. So if I move forward to the hedge fund, so with my other hat, NN squared, we design now that's a more they're systematic trade, so that's very different, and that's a completely different world for me to move into that area. But once again, it's a very competitive space, the hedge fund space, and one thing that every hedge fund trader will tell you is that the certainty in hedge fund trading is you'll design a fantastic trade and the edge will disappear. Within a certain time frame, pretty much every trade, the edge should disappear. The question is how long will it last before others see it? And that's a reality in a world where there's amazing brains and amazing resources being piled in by multi-billion-dollar hedge funds. So again, I've got to design trades that are not easily spotted. So the trades that I design for the hedge fund will be along the lines of second and third order trades. So if this happens, and this is trading at this level or price or whatever, then that will trigger a trade. Okay, and that so there by having more than one level of order before the trade gets triggered in this systematic way, it again makes it harder to spot. If I am just trading because a moving average crossed and something else happened, and it's too easy. They'll be found. That kind of trade cannot have edge, cannot last because it will be found very, very quickly.
Mm.
So the only way we have, particularly as a small hedge fund trader, of protecting ourselves on our edge from the bigger guys finding it is to try and work along this second, third, or fourth order. So if this and this and this and this is trading here, this gives us a trade. Then test that in the past, obviously test that in the future, test that live. Um, but again, we need that in order to keep our edge for as long as possible. So again, it comes down to I can't just simply trade off of chart levels or anything that's quite simplistic because I will have no edge within weeks or months or possibly ever as a hedge fund trader like that. So that comes back to the overarching theme of all of the three is can I find a style that is not easy for other people to replicate and find? If thousands and thousands of traders were trading the Norden method, it would probably become harder to make money in it. And if it was a straightforward style, that would be the case. But so that's been the overarching thing, whether it's position trading, scalping, when I mean position trading, I mean really holding things perhaps for half a day, maybe a couple days, um, or hedge funds, same thing. So trading without the charts, trading using fundamentals or uh, uh, other ways where people can't see things because my price is just triggered right now. Everything's lined up. I'm buying it right now. That's my price right now, whatever that is. Makes me harder to spot, makes my edge harder for other people to find. And I think both those things are important to have, longevity in the business.
Yeah, when you're talking about developing out, let's say the systematic type trades, what does that process look like? Is it something where you develop out like tens of them, or if you have three or four at one time that are giving you an edge, this is a good thing? What's the scope there of finding these unique edges?
Yeah, it's one of those things that you're just constantly doing. I have lists of trades ideas that I want to test. And I work. My partner in my hedge fund is a PhD in statistics, so he has that knowledge of testing, so we test it robustly. But we'll come up with with a hypothesis first. So we don't want to um, data snoop, which is something that is very common in the hedge fund industry. People just looking at data or charts and just trying to find something that looks like it's worked.
Yeah.
That's a very dangerous way to create trades. So we start with a hypothesis. If this happens and this happens, we think this market will trade this way. So then we'll test that hypothesis. Does it work? How strong is it? And then we'll test different strategies around that. So because we use options for a lot of our trades, we can test a bunch of different strategies. So different types of call spreads, different types of put spreads with different, strikes, 2% apart, 5% apart. We could test a whole range of strategies and then come up with the ones that have the risk reward drawdowns, whatever that we want, the ones that fit with our particular style, and we have generally a low risk type of outfit. So, we'll look for something like that. And the more we have, the better. In this environment of a hedge fund, the more we have, the better. You have to expect your edge to drop. Some of our trade, the performance has dropped a bit over the years. Others have remained pretty stable actually for the 8 or 9 years we've been looking at them, which is incredible. Um, but the more you have, and you should constantly work at this, constantly work at this.
Mhm.
Yeah, and for me, that was a sort of a new realm of doing things systematically. I found it enjoyable. I found it challenging, and that's pretty cool too.
Yeah, definitely.
I think that was the third of the three legs of the stool I was going to talk about: hedge fund scalping, and then the sort of more shorter term but intraday 1-2 day position trading, all with the idea not using charts. It doesn't matter what levels it's trading. Doesn't have to break through levels. This is, I think I think it's easier. That's how I was brought up to trade. That's how I was trained to trade, um, and it's carried forward. And I actually feel that as fewer and fewer traders trade that way, it's quite odd. It doesn't change. As
Mhm.
if we talk about this thing that happened today, I can explain a trade that unfolded today. Um, but this is a daily situation, really. That it hasn't changed. The markets still work that way.
Yeah. So maybe we can flip over some questions now because I would have several as well. I think this is
Yeah.
a really nice question to try to understand. If you are, Ben is just asking, if we use price to manage risk, how do you approach it if you're not worried about this? What are you doing for stop loss if you say, okay, this is the idea that I'm having, I'm getting in right now at value. Um, how do you think about stop loss and how do you treat that?
It's the same. I mean, I'm a conservative trader, so again, my view is if I've got this right, this thing should go up now. For example, if I buy it right, so I will keep a reasonably tight stop loss. My stop loss is based around my entry price. So whatever that entry price is, my stop loss will be. Let's say I think I can make this is if it's a stock, for example, I think it might go up 1.5% in the next couple of hours or so. All right, so I'll set a stop loss that's around that, maybe point 0.3. Right, if it goes down more than point 0.3 or point 0.4 of a percent, something like that, set up a risk reward just as anybody else would. But if it goes down, now too much, I'm wrong.
Okay, so
I'm not saying that I'm always 100% right. Of course not. But I have a stop loss there, or whether that's manual or automatic doesn't matter. But still, same thing. If I'm wrong, I'm wrong. But I
so
want to
this
be.
is
I don't want to lose.
Sure. So this is even on the scalping side of things. Whatever you're seeing that causes you to hit the button and enter, you wouldn't immediately just take that off if that entry price fails. You would base where you're taking that off, irregardless of why you entered, on just a risk to reward metric.
Yep, yep. So we do
Okay.
enter trades in a specific way with the scalping order method. Um, so that is another side to it. How we enter the trade is quite important. Um, but it will still be at around this price. It's just the way we enter it. There's some certain criteria that we need. But still, and one of the things about the Norden method is that the stop. So we only want to hold trades for a couple of seconds. So the stop is not just about price. It's also about time. That if after a couple of seconds it hasn't happened, you're wrong. So just get out of it.
Okay.
But usually, I mean, some of my students have stop losses. They'll put one in place just in case, like 6 ticks away or 7 ticks away, just in case. But they should manually exit before it gets there. It shouldn't be that. that great, right? They might have that just in case. But
Yeah.
time is another thing. If it hasn't happened, same thing. If I see some news and I think this is going to push this stock or this thing or whatever, and 10, 20 minutes, 30 minutes later, everyone's seen it and it hasn't happened, that's another reason to get out. It doesn't have to be just about price. It can be a time issue as well. Time, will tell you whether this is going to happen. And there's an old saying amongst market makers that if something, if something should go up and doesn't, it's about to go down. So if
Mm.
I buy this thing and I expect it to be rallying now because the yen's rising, so let's say the opposite, the yen is falling, so I expect this export stock to rise, and it doesn't, get out of it, right? Because it should, and if it doesn't, it's probably going to go the other way. So time is another factor that sometimes it's not just about price; it's just the time as well. Get out of it now.
When you have a specific idea that you're looking for, and you talk about, okay, you're seeing it, the reason to enter, maybe seeing strength, is the process you're using this, you're looking at a depth of market, and let's say it's just batting back and forth somewhere between 10 and 50 orders, and then all of a sudden you see 100 orders stepping in, and that's some kind of a go button for you? Or what do you, when you say you're seeing the strength, or you're having a reason to hit the button, what exactly are you looking at?
For the scalping, the trade could be triggered by a few things. Um, so if we go back to value, if you understand that the value of a contract can change even though the price hasn't, then that brings in things like correlations as well, which again comes back to my fundamental trading. That if you're trading something and you see something that's strongly correlated move, that might give you a bit of a heads up. Okay, I want to start trading, but you still, for the Norden method, because it's a market making style, there are still certain liquidity and other criteria that it has to meet for me to go in. Okay, so it's
Mhm.
not just, I'm not going to trade on any single, I can trade on any price as long as there's certain other things happening. But things like the number of orders, the pace of market, they will influence my decision of whether I can trade and how I can trade. And yeah, that they will influence my decision. Sometimes they will drive the decision, but not always.
Sure.
Um, and sometimes it's just the way the price has moved or has or is moving. Um, any of those things can influence your decision to trade, but they will definitely influence, how or whether you trade. So even if I see something happening elsewhere that I think my thing's going up, there's certain other criteria that will say to me, I just can't get involved right now in my market. That can happen too.
Sure. When you're looking and just observing the market, how important is it to you when you see a large liquidity level? Maybe there's, normally 150, 200 kind of spread all over the place, and then a few points away, there's 700 resting orders. How important is that to you, and what do you think about it?
Um, I it will depend on the market I'm in, which one I'm trading. Um, the influence it has is that I really don't want to be trading there.
Hmm.
Most of the time, I don't want to be trading there. So I come
Interesting.
from the view that when there's a large volume in a futures market, for example, I come from the view that I actually don't know what that person wants to do. Okay, I don't trust that they're just, if say it's an offer, right? I don't trust that they want to sell. They maybe want to sell, but if I did want to sell 700, is that really the best way to do it? I'm not sure. So I don't know what they want to do. So I come from it from the perspective of I don't know what they want to do, but I know that someone big has something to do,
Hmm.
and I want to stay out because I don't want to be in the crosshairs of someone big, and I don't want to be trading. So that again, a lot of traders in futures markets used that kind of volume to trade, and
Mhm.
perhaps they can figure out what that person's doing or what might happen, and that's fine. I just say to myself that I don't know what they're doing, and I don't think I can find that out. I think I can find better ways. Again, with the Northern method, the way it's developed and evolved over the years and it is now is I'm just trying to pick off small retail traders with their badly placed orders.
Yeah.
So I'm trying to avoid the big guys. Again, the theme of trying to not be around where they're playing, not being seen by them. But the same thing is, if I see them, I don't want to be there either. So I don't think I can beat them. I don't think I can. I don't want to play their game. They'll play their game. I've done that game as well. And my the quote I've used over the years is, and I think this annoys a lot of people, but if if you think sitting at home that you can work out what a big trader's trying to do, either you're wrong or he's rubbish.
Mm.
If you can consistently predict what these big traders are doing, then they're not very good. And if they're not very good, they won't last long anyway. But I kind of feel that sitting at home, to me, that's a known unknown, or whatever, so to speak. So I know he's there. I know he wants to play, because that's the reason why someone's put those big orders in. I just can't figure it out. I'm not trying to figure it out. I think
Yeah.
there's easier fish for me in terms of just picking off the retail traders. So if other people can find it, and I do know some people that think that they can spot that quite well, great. And if you can find a trading style around that, that's fine. It's just not my thing. I can't do it, and I'm not trying.
Yeah. A couple things, and I've referenced throughout, but just that I'm picking up as you're talking. One is just to draw some emphasis to this extreme, like niche thing of a very specific lane that you found yourself in for trading that makes sense to you that you're doing. And you've been doing it for years, and now you're branching out to kind of widen that out. But so much can be said for just having a proper identity of what you're doing and just doing that thing very well. And as you're just talking about sitting at home and understanding everything that's going on in the market. I think it should be said, and especially as retail traders, we should have a sense of humility because it's so easy to trade. We push a button. If you have a pulse and a checkbook on the same day, you can have a funded account and be in the market. So easy to get started, so easy to do, but so difficult to do consistently. And the understanding that from our perspective, we are undereducated, we are underfunded, we are under-equipped compared to a lot of market participants. And that should just give us all pause to not just be so active doing a bunch of things and finding that narrow lane that we can take advantage of. A couple other kind of questions here. One from AC just wants to know, how do you go for resetting the process, or how do you get back to an objective state after taking a bad loss?
Yeah, it's a great question. We're all going to get hit with them. The first thing you obviously try and do is to have a reasonably tight stop loss so that your losses are not big. I'm a huge believer in that. You try not to have big losses, right? Just try to keep losses small. We're going to have losses. Just try to keep them small. Um, every now and then it's just not possible, or something from left field or something, or you just mess up, right? And it happens. Um, with every loss, I just try to figure out what happened. Can I learn from it? And if I can learn from it, if I can figure out how to avoid that in the future, whether that is because I didn't put a stop loss in place and I know that I should have done, because I generally work with a manual, like stop. I've backed myself to be disciplined to do it, but every now and then I don't. And sometimes I have to say, right, you have to wear that and say, no, I need to do this. And if it happens too often, okay, I got to automate this now. So I'm a big
Mm,
believer in process. So try to figure out what happened and try to figure out a process to stop that happening again. And if I can do that, then it's a learning curve. I'm cool with that. Okay. If I can't learn from it, and to my students, when we talk about different markets, I talk about a few years ago I was testing the Norden method strategy on crude oil. Just wanted to have a go at it. I'd never traded commodities before. I'm generally an equities, index, and financials person. So I was trading Northern Method crude oil, and P&L wise was fine. P&L was actually pretty great for you know pretty much day after day. But, and this was the but, was every now and then in crude oil I'd get hit with a loss, like 9, 10, 12, 13, 14 ticks. The thing would just go through, right? And even though the P&L at the end of the day was good, and I was pretty comfortable with that, it was on a par with what I was doing in my other markets. I just didn't like the fact I couldn't figure out. After a few weeks, I just could not figure out why on those moments the market just did what it did. It was just, part of the randomness, right? That there's just orders were coming in. It was very volatile at the time, by the way. It wasn't like it is now. It was extremely volatile. But I just sat there and thought, I can find I trade other equity indices. It doesn't happen to me. So P&L kind of not relevant there in that way. I don't like the fact that things are happening to me that I can't understand. And despite the P&L, I'll move to something else because I can make decent money in something else where I do know when things go wrong, what happened. And
Mm,
some of that is just, at the moment you traded, there was a counter move or something happened. That's fine. I can cope with that. But I do try to work out what happened and then find a process to learn from it.
yeah, very nice. Jesper's asking, where do you look for value when trading the ES? I'm assuming most people who are going to listen to this are probably in the futures market, trading products like NQ and ES. You've talked a lot
Yeah.
about the difference between this value and price. Do you have anything to add to where you look for value when trading the ES?
Well, in terms of ES, you'll look at the contracts around it. So, what contracts does it correlate with? What contracts could influence it? So, ES can be pulled up and down by NQ. So, you'd be looking at that sometimes. What else? Well, what are the biggest stocks in the ES? They can pull it up and down. Today, is Alphabet moving the NQ? Of course it is. If it turned around, would the NQ turn? It's like when we came on here, Nasdaq's down like 2% today or something, right? If Alphabet started to turn around, would the Nasdaq turn around? 100% it would. So you're looking at things are correlated because that's how markets move.
Hmm.
The ES can't fall or rise unless the stocks within it fall or rise. They're inextricably linked, right? So they're going to be an influence on it. The index, and then there's the spider ETFs, and that's huge volumes are going into that. So if there's a big flow going into that, that's going to help. And one of the things I always say to people, if you're trading futures, they're a derivative, right? That's what they are. They are a derivative. And we can read the order book in the ES, right? Or you can think you can read the order book in the ES, but you don't think it's being influenced by the stock market. You don't think it's being influenced by the spiders and all the ETF flows at this moment, which can be huge. You don't think it's being influenced by the flows of options at this moment. So what we see in the order book is a fraction of the liquidity that's actually affecting the ES.
Hmm.
Again, that's why I don't look at volume and the order book and charts in that way because I don't think it's going to tell me what I think people think it's going to tell them. Um, or what it tells me, the DOM and the book, it tells me how the market's trading, how orders are being filled. That's important to me. Um, and then the liquidity factors, which will affect whether or not I think I can trade here or get a good fill or those sorts of things. But in terms of coming back to Jesper's question, you can have a look at all of the markets around it, what's influencing it. They can all tell you, give you some sort of inclination.
Great. Zoloff is asking, is Gary an intraday trader nowadays?
So nowadays, I try to, yeah, I'm generally always an intraday trader, but the hedge fund, which is where I'm really focused my systematic trading design, they are held for a few days. But otherwise, I generally always prefer intraday trading, whether it's scalping or holding trades for. I'm doing a little bit of work at the moment with some traders, which is a little bit out of my comfort zone in terms of some new markets that I'm looking at for me, and holding trades a bit longer because that's their comfort zone. But they're still intraday. And again, coming back, what are we? What are we? We're small traders. Every day things can change. We didn't see the Nasdaq going down 2.5% or whatever it is now yesterday, right? So yesterday you might have been fine holding longs, and today you hate it. So yeah, I believe for retail traders, you're much better off trading intraday.
Yeah. When you are scalping, how many points or ticks are you usually aiming for?
Yep. So if we come to the Norden method, we're trying to hold trades for a few seconds. So what does your market move in a few seconds? If you're trading ES, it's usually 1, 2, 3 maybe ticks, right? That's it. If you're trading NQ, that number can be more. It can be 6, 7, 8, 9, 10, things like that. So um, again, taking that intraday idea down to the smallest possible, with the idea that again, we want to be hidden, right? The longer you're in the market with a trade, the more likely it is that you can get screwed. That's the way I always look at
Hmm.
it when I trade for myself with my own money. The longer I hold a trade, it's Murphy's Sod's Law, whatever you want to call it, right? The longer you hold a trade, the more likely it is it's going to go against you. That's just the way it seems to go as traders. So the Norden method says, okay, small traders, retail traders, let's take this to the smallest possible. Can I just hold this trade for 2 seconds? The chances of someone picking me off or getting this, losing my account on holding something for 2 seconds is very small. And then just try and do that 20, 30, 40 times a session or however many times you can get it done.
Yeah, very interesting. Um, and you might have just answered this one. Somebody's asking mixed beans. How many trades you take on an average day? Would you say 30 to 40, like you just said, is a normal day?
Yeah, so I think if you're trading something like, let's say, NQ, depending on how long you're trading for, if you're trading RTH, NQ, a decent Northern Method trader can trade 20 to 30 times an hour um, comfortably. So extrapolate that. Most people don't want to do this for 5 hours a day, for example. It's too intense, but you can do 20 to 30 trades in an hour if you're decent at it, and good skills and quick.
Yeah. For
And
you
that still means
personally,
you're out of the market a lot. Sorry. If you think about it, 20 trades, right, held for 2 seconds, or in an NQ, often it's 1 second, right? You're holding trades for you've traded 20 or 30, 20 times in an hour and you haven't held a trade in total for like 1 minute.
mm,
All of the trades combined probably haven't held for 1 minute out of an hour.
yeah.
And that's something people think, oh, loads of risk, loads of risk. Think about it. Over an hour, I've been in the market for 1 minute. How much loss can I take in that time?
Mm,
But actually, what can I build in that time is quite, it's quite cool actually. So um, that I think that's a very strong point,
yeah, I would agree. That's
but not for everybody.
sure. For you personally, when we're maybe if the market picks up volatility and we're seeing like outsized volatility, a ton of movement, big swings, is this more of a blessing or a curse for you?
Yes and yes. We have to adapt the way we trade, so we have to. There's certain adaptations we will make in higher volatility times. Generally, we will trade a little bit less. The blessing is that most traders, even some professional traders, struggle when volatility gets high. And the Norton method is all about picking off poorly placed orders. And
Mm,
when volatility gets higher, there's more of those. So we can become a little bit more defensive and, explain to my students about defensive trading and aggressive. We can trade a bit less, and generally the trades will have more profit in them.
okay.
Um, but always, if you get it wrong on those days, you're going to get screwed more. But that's why we have to be a bit more defensive. But so, for example, one thing when markets get volatile, the bond market, if you go to like 30s, for example, 30s and ultras can be good markets for us. The tick size is excellent, tick value is excellent. Um, but also, bond traders tend to be, they prefer slower, steady markets. Bond prices don't move very much normally, right? So they like that. When things get fast, that's when they struggle. And that's cool because our style is all about really faster markets the better. So sometimes even those pros who are bond traders, they hate trying to fill orders when markets going crazy. So we can even pick off some of those boys.
Yeah, very good. Do we have time, Gary? Can we walk through? I know you said that you'd like to go over a trade that happened today. Could you walk us through that and kind of your thought process?
Yeah, very, very quick. This is so I'm working with this traders at the moment, which is a new thing for me, and it's more about intraday trading. That's what their thing is. Holding trades, maybe one or two trades a day. I've noticed that's probably what most people do. Right? For me, it's out of my comfort zone. It's not really looking at liquidity and Northern Method style. So today, we're looking mainly at metals as well, which is new for me. Gold, silver, copper are the three main markets that we've been looking at and trading. So today, I look at the picture around me. What's happening to yields? What's happening to the dollar? And trying to build a picture for these contracts. Now today, gold in the Asian session was up a little bit, up 0.2, 0.3, and I really didn't get the move right. So I'm getting asked, "Oh, should we be buying gold? Should we fade it? Blah blah blah." I'm like, I look, there's nothing on my radar that tells me that gold should be here, but that can happen, right? Intraday, that people just buying it. They don't need to have the same reasons that I do. But then About this afternoon, our time in Asia, or coming into the evening, actually into the evening, just before the US Open, maybe half an hour before Eastern time, 8, maybe 7 o'clock in the morning, 6, 7 in the morning, started to see some moves, right? Bonds started to rally, yields are falling. That's usually pretty good for gold. The US dollar was falling. It had been falling against the yen all day, but that's a different matter. That's to do with the yen and the carry trade and the BOJ and all that kind of stuff. But it started to fall against other currencies, particularly the Swiss franc. The Swiss franc was rallying against everything, which is a bit of a safe haven play. And I've often seen that when Swiss franc rallies, gold might rally. Again, not 100% correlation, but I've seen that. Put that with yields. So yields are falling, which is usually good for gold. Dollars falling, usually good for gold. Swiss franc rallying. I put that picture together and say, right, at this moment, now I can see a reason to buy gold. Right, at this moment, whatever the price was, it was up about 0.3% on the day at the time. Um, and then over the next hour, it rallied another 0.5%. So the point was, in the morning, I didn't understand the move. I didn't try to understand the move, and I didn't trade that move. There was nothing. But then when everything lined up, I go, yeah, this. Usually, again, all I can think about is I think it's a high probability trade. Usually, when all these things line up, I think on this sort of information, gold should rally. I'll put a stop loss, maybe 0.15 or something below, which may be like, $2 below, and I'll target perhaps $10. And yeah, over the next hour or so, it moved. And that's just a classic example. Again, it's not looking at liquidity or those sorts of things. That's just an intraday trade, which, is something, as I say, that I've started to do a lot more of, which is a little bit out of my comfort zone for a while. But that's how the trade came in. And okay, a lot of the time you'll look at it and you can't build the picture. So either you'll fade it, which is, if I'm only going to fade it if the picture goes against it. And there have been times. So when gold recently, a few weeks ago, when it first hit its highs, was a really interesting day. I think it was the first time it hit its highs, the futures. Um, it was, I think it was a Thursday or Friday. It might have been a Friday. And what was really interesting was all the other information that I saw should have sent gold down. And I suspect because it was around its highs, a lot of traders came in and were like, oh, they bought it, that they were euphoric that day. I said to my group, I can't get involved in this. I don't want it, right? I don't like this. And on the Monday morning, in fact, because a lot of it happened after we'd gone to bed, the rally came late in the US session. I'd already gone to bed. I came in Monday morning. I'm like, what is gold doing up there?
Mhm.
Like, it's everything else was like no. So when the picture is completely the opposite, but that went up, we'll fade that. And so that was a short. And the next day, it just on the Monday it plummeted. Like it fell very quickly. And similar situation for silver. So put the picture together. It doesn't always work in terms of sometimes the market will do what it does. Um, if it's mixed, I might not trade it. If it's clearly, I think the wrong way, I could fade it. But like today, as I say, a lot of the time, leave it alone, leave it alone. Then the news happens, right? Then we can trade.
Yeah.
And price wise, it didn't matter. Whatever it's trading now, I think the value of gold is going to change because everything around it's changed.
Yeah. Regardless of, thank you for walking us through that, by the way, as well. And regardless of if you are trying to do exactly what Gary Norden is doing, there's so much to take away from just this mindset and this approach to the market. Some things you were just talking about while you were going through this review. The idea of, you started trading at 19 years old, been on this on the actual floor, transitioned to the screens, having a very long career here. And to this day, just recognizing there's a lot of things that just don't make sense to you. And there's a lot of confusion. And through those moments of confusion, just not doing anything and waiting for those moments of clarity where the picture comes together, you understand what makes sense, you understand that there's some type of an edge here for you. And I know as traders, it's very difficult to do, to just be okay in those moments where you have like a partial feeling of kind of what's going on, but you're seeing some conflicting information, and being able to just not act and then act when you have those moments of clarity, and just maybe the realization that the majority of the time you're looking at the screens potentially, it's not going to be clear, and being okay with that. Um, yeah, great. So thanks for tipping on that. And then maybe as one final point, being on the screens for so long, not so long, but having just a long trading career, starting so young at 19, and even through to this day, hearing you talk about things that you are challenging yourself with, things that you are, refining, things that you're pushing through, the level of effort that you're putting in now, is a beautiful thing as well. And just a reminder for everybody, when we come to the space of trading, it's not about just learning a set of indicators and then sitting back and pushing those buttons every day. This is a challenging environment that requires us to if we want to be in this, to be competitive and to refine what we do, and to be on the edge of continuing to further ourselves, no matter how long we've been doing this. So these are some beautiful things that I was able to take away from this as well. As we're wrapping up now, just as some final thoughts on your side, could you tell us just where people can find you, and if as people are listening to this, if they are interested, or if you feel pulled into this idea of learning more about scalping specifically? I know the Norden method is very a scalping method. Where can people find? Where can people join? Where can people get on board?
Yeah, so the Norden method is at nordenmethod.com. And like I say, very specific scalping style. There's more information about me at garynorden.com, just about what I do, and about the other things that I do, hedge fund and books and things like that. I've got a YouTube channel, nowhere near as nice as yours, Aaron, and I don't put out anything as good as you do, but there's a few things on there. But yeah, they're the main things that I do out there.
Awesome. Very good. Okay. Thank you very much for the time. And I know we went a little bit over, but yeah, it was great. I really enjoyed it. And thank you very much. So I'll wish you a great rest of the trading day if you're still staying on the screens, and a good rest of the year. And hopefully we catch up soon. I know I would enjoy that. So once again, a big thanks for coming on.
Thank you very much. Thanks for having me.